Good day and thank you for standing by. Welcome to the Prysmian first half 2025 integrated results conference call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during the session, you will need to press star 11 on your telephone. You will then hear an automated message advising your hand is raised. To withdraw your question, please press star 11 again. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your speaker today, Massimo Battaini, CEO. Please go ahead.
Thank you. Good morning and welcome to the first half 25 result call. I'm very excited to show the result achieved in quarter 225, above the 600 million. This sets a new record for the company EBITDA. The last best quarter was quarter 24, the first quarter after the consolidation anchor wire, 540, but 605 is definitely an outstanding performance that has beaten and outperformed the past results. It is true there is some 10 million plus from channel perimeter change, but there is also an adverse forex impact in our quarter 225 result versus the previous 540 of quarter 324. Amazing is the 14.5% in margins, indicating a significant accretion of margin across all business segments, transmission, power grid, but also INC and digital solution. The organic growth in the first half posted a nice 4%, which is basically coming across all the segment of business. 1 billion is the free cash flow of the last 12 months, confirming that we are solid in delivering the free cash flow guidance that, by the way, we updated for the full year. To be noted, the faster consolidation of channel in our perimeter from June, only less than 2 months after the signing, and also on the CO2 emission and the ESG target, you will see later, a significant reduction of CO2 emission in scope 1 and 2 versus 2019 of 38%, heading for a 40% for the full year scope. Moving to some achievement, I think we never celebrate our achievement. Here we want to make sure that we all understand that not only are we focusing on the results, on the company improvement, on the growth, we are also setting the foundation for the future opportunity for growth. There are, in the first bucket of comments, achievement in the different segment of business, in blue font, Mona Lisa and Piccola Christening. So an important milestone in confirming our track record in delivering the expansion of capacity, both manufacturing installation on time and on cost. Several agreements in power grid space. Stargate data center, larger project adjudicated to us in US for a Texan project in terms of electrification cables and also digital solution cables. And very important, the consolidation and expansion of connectivity space within Prysmian, leveraging channel and Warren Brown. But I'm much more proud of what there is underneath. A lot of innovations. The first cables 245 for dynamic solution for floating wind offshore platform. A solution for connecting the substation to the grid with a medium voltage plug and play cables with the connectorized edges. Fire resistant range of products, new range of product for the US. And probably the most striking one is the hollow core fiber technology. We partner with a startup in US. They develop a solution. We are industrializing it. This will allow to produce and sell cables, fiber optical cables, whose core is empty, is void, so that the light data are transferred at higher speed in air than in glass, allowing data center to be spread over the territory without insisting on the same power grid. So making the data center expansion facilitated. So these innovations are key to confirm our leadership in technological space and supporting the further growth of the company in the coming years. Let me move now to the individual business. Transmission is the star of this first half. I like to comment on the first half result, 250 million EBITDA for the full first half versus 150 last year. So 100 million more in the same period, with an important and significant growth in EBITDA margin from 14% to 17%. This again remarks the solidity of this business, remarks our confidence in achieving the 18 to 20% target in margins by 2028, as per our Capital Market Day. And with 250 million per semester, we see the journey through 1 billion goal by 2028, 1 billion goal EBITDA within reach, thanks to the solid expansion of the capacity and thanks to the solid execution of the project of better margin that we have in our backlog. In Power Grid, we are also happy to confirm stability of margins. In fact, margins have gone up. 15.6% EBITDA margin in Q2 is higher than what we reported for Q1 25. The growth is substantial, 5%, leveraging the capacity that we unlocked towards the end of 2024, and signaling that the market demand in the US in terms of grid enhancement is pretty strong and solid, and driven by solid secular trends. INC, also in INC Q2, you see the significant jump in EBITDA margin, indicating the highly accretive contribution of anchor wire to the performance of the INC business in US and in the entire group. 10.6% of the reported numbers for 2024 Q2. Overall, year over year is at 14.1% this year, with a significant improvement over last year. The growth was not certainly significant in this Q2, but the environment is pretty bumpy, and our focus is on profitability. We didn't lose market share, actually grown market share thanks to our solid service level coming from anchor wire. Q2 last year was particularly stronger. We really want to focus on service and profitability and maintain our leadership in the market in terms of setting prices in the US market. Specialties, we have some organic growth, not bad. The EBITDA margin is not yet at the level of last year. We are still suffering from the softening that we've seen in the automotive space. We are close to finally disposing the last two factories that we want to get rid of in the automotive space. This will happen before the end of Q3. We also had a negative impact coming from exchange rate, but more importantly, coming from a softening in the residential elevator business in the US. All the rest is solid, driven by a significant amount of projects across all the verticals, shipyards, defense, fire-resistant products, and crane and mining, and so on. Digital reflects the benefit of the perimeter change. Twofold: the EBITDA margin surged from 13.3% last year to 16.8%, and this accounts only for 1 month out of 3 where we consolidated a channel that namely was June. And the 20 million improvement in EBITDA partly come from channel for more than 10 million plus per the June month, and the rest is the organic growth of the company. Master meter channel is outperforming our expectation. As we've seen market rebounding in the fiber to the home cable business in US, channel is enjoying a significant rebound in volume and also profitability in the connectivity space in US. The combination of the two will make us a stronger provider of fiber to the home solution to the US market, with exposure also to data center. ESG KPIs, I rather comment the two on the top right side of the page. 44% is a big share of the total revenue, which is linked, which is associated to sustainable solutions, so recycled content of material, product whose carbon footprint is lower, product that can enhance our position in terms of supporting customers towards their goals in making them, allowing them to achieve the sustainability goals. Remarkable is also the 19.9, the 20% of recycled content in our product. This is driven paradoxically by the tariff. The US market had an excess of waste of copper available. China's that used to buy this waste didn't buy it because of the additional cost. ANCO, we took immediately the opportunity. ANCO recycled up to 30-40% of waste into the virgin material in the McKinney facility. So ANCO has proven to be taking advantage of the cost benefit of your recycling waste, but also taking advantage of the recyclability part, the ESG part of this topic. Let me hand over to Francesco for more financial insights into the P&L and the free cash flow.
Thank you, Massimo, and good morning to everybody. A very robust set of half-one results, as Massimo anticipated. Revenues not far from the 10 billion level, 9.6 billion in the first half, and the first half organic growth at 4%. Recapping the main messages on growth, certainly a very strong transmission business, where the growth confirmed the strength that we had already seen in the first quarter. A nice improvement in terms of growth in the power grid business, both in Europe and in North America, I would say. A good growth also organic and in digital solution, with particularly strong North America. And also definitely an improvement in terms of a sequential improvement, at least, in the electrification, namely in the INC, where we posted some good growth compared to the first quarter. So all in all, 4%. I think even better in terms of EBITDA performance. Massimo anticipated a record second quarter at 605, with margins at constant, at standard metal price at 14.5%, and also half year, you see the accretion at standard metal price is very significant, from 12.6% to 13.8%, plus 1.2%. Is an accretion which is mainly driven by transmission, which is achieving already in the first half the 17% level in terms of EBITDA margin, but also power grid with margin staying stable, actually even slightly improving at a very good and very high level. And of course, is an accretion which is also benefiting of the significant changes of perimeter that we benefit of in this first half. The anchor wire consolidation, of course, compared to the first half 2024, and last but not least, the fast and quick closing we had on the channel acquisition, which is starting to contribute and to enhance our profitability quite nicely in the month of June, since the month of June, and which will be a definitely better upside on the digital solution in terms of margin for the second half. Below the line, below the adjusted EBITDA line, very few comments. Basically neutral adjustments, 2 million, benefiting from the gains that we realized on the 8% stake that we have sold so far of YOFC. These 8%, by the way, excludes the further 5.5% that we disposed of in July. Here, of course, the cutoff date is end of June. We have definitely a level of financial charges at 145 million, which reflects the new perimeter. It is substantially in line with our expectation, and tax rate in line with the 27% that we were anticipating at the Capital Market Day. All in all, this results in a very strong boost on our group net income. You remember that the first quarter reached 150. This means a second quarter at 276 million, giving the 426 million year-to-date June. I think we are very well set to achieve the first year of our 4-year plan for group net income and EPS growth, which is, I'm sure you remember, a metric that we were setting, a very important metric we were setting in New York. You remember that we were setting a range for the 4-year in between 15 and 19% CAGR. And I'm very confident that in this first year of the 4-year, we may even achieve this, we may even exceed this range with an EPS growth, which in my opinion will be higher than 20%. Let me now flip to the very solid cash flow delivery that we had in the last 12 months, solid and pretty much stable at the level of 1 billion compared to Q1 last 12 months and also the full year 2024. This is even more solid if we think that in this 979 million we discounted pretty much a peak in terms of CapEx. You see this 940 million. This a very high level of CapEx will progressively decrease on a full year base to the level that we have already anticipated to you of approximately 750 million, for the simple reason that this year CapEx are distributed much more evenly, much more linearly than last year. And this will drive our cash flow up toward the new level of guidance that we have decided to upgrade and that Massimo will comment in a while. Let me maybe remark here that you see that this is a bridge of debt from June last year to June this year, and you see the accounting treatment of the hybrid bond. You see the cash inflow close to 1,989 million net of some transaction costs. This means that IFRS, as I'm sure you are aware, the hybrid bond is treated as equity. So basically, it's a reduction to our debt. This is, of course, a different treatment than the view that, for instance, the rating agencies is having, where half 50% of the hybrid bond is treated as debt. Just to clarify the accounting treatment, which may be not so easy or not so simple for you to understand. Excellent. I think I'm over, and I hand it back to Massimo.
Thank you, Francesco. Let me move to the guidance, and I'd like to draw your attention to the chart on the right-hand side of the page. You see how we built it. Is starting point, the previous guidance was set at 2.3 billion euros plus minus 50 million. We are happy to upgrade the Prysmian perimeter guidance by a number that you can figure out is 40 million. And then there is the perimeter effect added on top, unfortunately offset in our assumption by the Forex. As said before, we are happy about the performance of Channel. The consolidation of June is extremely accretive to the group, and the trend of EBITDA that we see in the coming months is comforting us on this important acquisition for the American perimeter, for the US telecom space, and giving us a significant upside. Forex, maybe we've been too cautious on this assumption, but we think that was the right way to define the new guidance with a possible offset between Channel and Forex. Said this, I mean, today, after having seen last night changes in the tariff system of the US, whereby now the 50% that was expected to be applicable to copper, cathode, and rod imports from all the other countries, from overseas, and only to raw material and not to derivatives, so to finished products, after what happened last night, whereby the tariffs are going to be applied to rod only and not to cathode, but also to all cables imported from overseas, I must say that I feel much stronger today for what this guidance is expected to deliver for 24, for 25, and also I would like to say that I see upside coming from the new tariff system. Also, in light of the possibility that the same approach that has been set for copper will be also applied to aluminum, where for the time being we have only tariff applied to raw material and not to finished product imported from overseas. So we feel much more relieved. We feel that the administration is taking the right decision to finally protect and preserve local jobs and growth of US-based manufacturers. And we are one of them. 99.5% of what we sell in US is produced locally. And finally, this will do justice to our investment in the US-based territory. We have also upgraded the free cash flow guidance from the 1 billion mark minus 50 plus 50 to 1 billion minimum, 1 billion 75 max range, 1 billion and 40 midpoint. So moving to the closing remark, I'd like to confirm the positive and outstanding performance delivered by all segments of business in Q2. Also, INC that posted some negative growth versus Q2 last year, in reality has grown by 5.4% in Q2 25 over Q1. So sequentially, there's been a significant growth and improvement in EBITDA margin in INC North America. Margin expansion across all segments, the 1 billion level of free cash flow confirmed, and the upgraded guidance set an important milestone for us in confirming that the targets that we set for 2028 at the Capital Market Day in New York a few months ago are within reach, and possibly we might see some upside. So the 2.3 billion to 2 billion 340 million EBITDA paves the way for the 3.1 billion level of target for 2028. The 1 billion plus free cash flow of this year is in line with what we want to achieve by 2026-28 with 1.6 million free cash flow. EPS, in fact, actually has outpaced already the target that we set for 2028. And the innovation that I showed you in this second page of the presentation highlight how important for us is to move towards solutions in order to strengthen our portfolio and our customer relationship and our opportunity for growth. So thank you for this preliminary presentation. I'll leave the floor to your questions.
Thank you. As a reminder, to ask a question, please press *11 on your telephone and wait for your name to be announced. To withdraw your question, please press *1 and 1 again. We will now take the first question from the line of Daniela Costa from Goldman Sachs. Please go ahead.
Hi, good morning. Thank you for taking my question. If it's possible, I would like to ask three things, but maybe the first one, just expanding on the comments just now regarding the potential from the copper tariffs announced yesterday. Can you talk through what do you think this is going to do? How much are imports now? How could this cause sort of the shortage and fears about shortage that we had in 2021? What would you see has potential on core margins upside from that? I'll start on that one and then I'll ask the other.
Thank you, Daniela. So tariff, the original assumption was that tariff would have been applied to cathode and rod imported from overseas. But of course, the local production would have raised prices to the level of the imports. So the driving impact would have been that we would have needed to pass 1.3 billion of extra copper costs to the market, creating a potential shock to the local demand. This was our concern. with a new situation, only rod imported are going to suffer this. And as far as we're concerned, out of the total rod that we need in the US, we only buy less than 10% of this rod from Canada. So we will have a marginal impact in cost in this import of rod in the US. But on the contrary, all the imports of cables, medium voltage, low voltage, high voltage copper cable that are imported from overseas, Korea, India, Mexico, and so on, will be penalized with 50% applied not only to the copper content of the cable, but to the entire cable value. So this, on the one hand, we will not see a significant inflation impact due to the copper cost rise in the market. You must have seen that already the COMEX, which is the metal value of copper in US, has increased by 50%, even ahead of the target application in the last few weeks versus the LME European value. And so thus inflation will not hit the local demand. And on the contrary, the local producers, like we are, will benefit from cost of cables imported from overseas much higher than today. So this will certainly benefit our guidance, our forecast for the full year, but we will see in the coming weeks how this will come into play.
Got it. Just quickly on that, what percentage is imports? Is it around 30% of the market in copper? I know in aluminium is higher, but how much do you assess it is in copper?
The copper demand in US across the whole industry is 1.6 million tons. Out of this 1.6 million tons of copper, 75% rod is produced locally, 25% is imported. But 50% of the cathode is produced locally and 50% of the cathode is imported. So in the previous version of tariff, the cathode was penalized with 50% tariff. Now this is not the case any longer. And only the rod import in US, which is only 25% of the total need, will suffer this 50% impact.
Mm-hmm.
I don't know if I've been able to explain it.
Cable imports.
But the cable import is what matters us, no? Because at the end of the day, we don't rely much on rod imports, on cathode, not at all. On rod import, we have only 10% of the total needs for our business. So anchor wire, as you mentioned before, will benefit from it because there will be no an unnecessary cost to be passed to the market. And on the contrary, not necessarily in the anchor wire space, but across power grid high voltage, we will have importers of power grid cables, high voltage cable, penalized by the 50% applied to cables. Fine.
All right, super helpful. Thank you. My second question was going to be, I think in electrification in the US, you have a sizable share of data centers. We've heard many companies having very big double-digit growth in data centers, but when we look at your electrification business altogether, the organic growth was still 1.5. Can you maybe divide it up between data centers and the rest? Why wasn't the growth higher given the high data center exposure?
Thank you for the question, because this helped me allow me to explain the dynamics of the market. Until yesterday, we noticed the residential market was kind of sluggish, has been very soft over the last 24 months. But the non-residential market, due to this potential negative impact of tariffs on the cost of the products, has started to soften also. Data center, which are considered non-residential business, have made the total non-residential market growing in 25 over 2024. But if it wasn't only for the non-residential excluding data center, we would have seen a slight deterioration in market demand. So data center is growing. Our exposure to data center is larger. The organic growth that you see in INC is in the quarter two sequentially over quarter one high is 5.4% growth. And this is driven by data center, basically. And the softening in non-residential business demand that we notice in quarter one, quarter two, we think will revert into a positive trend given the recent last night new resolution on the copper tariffs. tariff copper at 50%, we're certainly saddling the entire project cost with an unnecessary implemented cost. This will, in my view, relieve the investors, will leave the companies, data center, no data center, infrastructure investment in US, and remove some heavy uncertainty that has weighted on the US market in the last 6 months.
Got it. Thank you. And just finally on the backlog in transmission, which is sequentially slightly down, do you still expect it that we will end up the year with a backlog above, higher than we started?
This is the expectation. There's not been much order intake in the industry in the first half of this year. We expect significant awards of business from National Grid in second half, from IPTO and from Turner, from other TSOs in second half. So what we expect to gain in second half will not fully offset by the revenue that we have to deliver in second half. So we do expect to see a slight improvement on the 16 billion level of backlog, which is, by the way, not as low as we want it to be. Because the high backlog is nice on the one end, but prevent us from competing, from being able to compete on new tenders, because our capacity is fully sold out through 2029. So a level of backlog between 14 and 16 billion is what we reckon is more healthy to have us to be competitive in terms of flexibility to plan work and respond to the new projects, to the new project intake.
Thank you very much.
Thank you. Welcome, Daniel.
Thank you. We will now take the next question. One moment, please. From the line of Sean McLoughlin from HSBC, please go ahead.
Thank you. Good morning. I had two questions. Firstly, on grid. So organic growth bounced back from a negative Q1. We're at the mid-single digit organic growth level that ultimately you've guided for out to 2028. I mean, is this the new normal, or could we see an acceleration of that organic growth in H2? And just wanted also to understand regionally what drove that rebound in Q2. That's the first question. Thanks.
Thank you, Sean. But for the first time, we're talking about other regions than the US. The organic growth has been pretty high in Europe. Europe investment across all utilities has grown massively. We should consider this growth in Europe well above the 5% global growth of the group. Across all countries, we're seeing these revamped needs of intensifying and electrifying final users, which push additional pressure on the existing grids, especially in high voltage grid, but also in power distribution grid. But to be honest, also in the United States, the demand has been pretty solid in this Q2 over Q1. Is also by design that Q2 is strong because the season, the summer season, allow installation, allow contractor to work to a different extent than what happened in Q1. As far as US is concerned, we expect the second half to benefit from additional capacity expansion. This will come to fruition at the beginning of Q4. Then, as far as the growth rate for 3 and 4, we had to gauge. Now, as said before, we are in the middle of a transition from a tariff system that was not supporting a local producer. We had in this space to pass on to the market significant cost of copper increase, which is not the case any longer. So I'd rather hold my judgment second half until we see how this will be deployed in the market. With the new system of tariff will be deployed in the market. But I'm pretty positive about second half organic growth across the regions.
Thank you. And I mean, staying in grid, I just wanted maybe any comment on broader overhead transmission project risks in the US following Grain Belt Express project had its government loan guarantee cancelled. I mean, are there any other projects maybe that you're involved in that face these kind of risks, or how should we think about the transmission market in the US?
But we have one large project with in energy in the so-called overhead line transmission overhead line project, Grain Belt, which was benefiting from, and is a kind of renewable project because it's connecting grids of different states, 3 states. There was also benefiting this project from incentives that had been removed, but the project has stood up also without incentive. In fact, the project started without incentive benefit, and customer confirmed it will continue with the execution of this project, for which we already received a good down payment, advance payment a couple of years ago when the project was launched. As far as new project concerned, I don't see this happening. On the contrary, the one big, beautiful bill, there are a lot of, let me say, facilitation to spur the demand of power grid cables to strengthen the grid. It is true that the investment in renewable solar and wind will not benefit from tax credit any longer, but equally it's true that there is a strong push to make the grid more robust, facilitating permitting, facilitating the local production, and incentivize the local production to support the power grid expansion in the US. So I also see positive market trends arising from this one big beautiful bill that's been just implemented a few weeks ago.
Thank you, Massimo.
Thank you. Welcome, Sean.
Thank you. We will now take the next question from the line of Akash Gupta from JP Morgan. Please go ahead.
Yes, hi, good morning, and I have only one question. My question is on INC growth in the quarter. You had like -3.2% negative in Q2, and I'm wondering if you can provide some color on what did you see in different regions in Europe versus US, and within US, what was the growth rate in Encore and outside Encore? And then when we look ahead into Q3, do you see prospect of double-digit growth in some region in INC, as indicated by one of your peers recently? Thank you.
Yeah, thank you. One of the drivers of this negative growth in quarter 2 25 is unfortunately the difficult tough comparison towards quarter 2 2024, especially in US quarter 2 2024, including pro forma, of course, the perimeter of Anchor Wire. There was a significant demand which benefited Anchor Wire back in quarter 2 last year. But sequentially, as mentioned, the INC growth in quarter 2 over quarter 1 is high, is 5.4% across the board. It is high in US. It is actually stable in Europe, the demand of INC business. We noticed this also from comment from our distributors, Vercel, Sonepar, which see stabilization of demand in Europe for the time being. And luckily, we can compensate some stabilization and see with additional demand in data center space also in Europe. Then what we see in quarter 3, 4, and quarter 4 is probably a new scenario, no? Because this scenario discounted or this organic growth over 24 or discounted a significant uncertainty in the US market arising from this a huge cost coming from the application of aluminum tariff and the road tariffs. With the new scenario, I mean, a lot of those inflations, or the inflation that we expected to see in the market, which could and had partially slowed down the non-residential business, excluding data center, will disappear, will fade away. So it is probably too early to say what will be the scenario in terms of organic growth in quarter 3, 4. But I feel, as I said before, much more positive than I was 24 hours ago.
Thank you.
All right, Akash.
Thank you. We will now take the next question from the line of Uma Samlin from Bank of America. Please go ahead.
Hi, good morning, everyone. Thank you so much for taking my question. First is a follow-up on INC. So, given the current corporate situation, do you think, it seems like you're saying you've been gaining market share and you're expecting to see a better H2 going forward. Then should I should we be able to expect both a pickup in growth rate in I&C and also better margins on the back of the corporate tariffs?
We will see finally a lack of deterioration of the demand in US because the huge cost coming from 50% applied to comics, and the comics cost is pretty high. We're talking about $10,000 per ton, which has become $15,000 per ton as a result of the original tariffs will disappear. So we expect the market to rebound in terms of demand. Data center were already, even despite the tariff in Q1, Q2, a strong driver of growth in US. So I expect to see more organic growth in Q3, Q4. But I said before, let's wait and see. It will certainly be another trigger of opportunity if they apply this principle of not penalizing the rod cost, but penalizing the cable imports from overseas with higher tariff. This principle has been applied to copper, will also be extended to aluminum. So if in both situations of this material, copper and aluminum, we had the tariff applied to cables as happened over last night for copper, we will have a simpler situation and much less cost to pass to the market, and all the importers being disadvantaged versus the local producer. This will certainly drive our organic growth massively. But let's wait and see. I hope this will also happen for the aluminum space.
Thank you very much. That's super helpful. My second question is on your new guidance. So you updated that by 40 million. And is that more of a reflection of the better I&C and primarily I&C earnings in the first half? So I guess, what are your growth and margin assumptions for I&C and grid for the second half to support this guidance? And, do you have any growth acceleration in H2 already baked into this guidance?
I think the 40 million upgrade of the legacy Prysmian guidance is based on the growth in transmission, which is coming in pretty well, ahead of expectation. Is also based on the growth in power grid that we've seen in Q2, sequentially year over year. And also based on the fact that there are some additional volume opportunity that we think we will be able to capture in Q3 and Q4. As said before, doesn't reflect at all the new change in tariffs dynamics because we didn't know this until midnight yesterday. That's why I said that we might see some upside from what we posted today as guidance for the full year.
That's very helpful. Thank you very much.
Thank you.
Thank you. We will now take the next question from the line of Monica Bosio from Intesa Sanpaolo. Please go ahead.
Good morning, all, and thanks for taking my questions. I hope you can hear me well. I have four. The first is on the power grid in the USA. I'm just curious, what is now the balance between demand and supply? Is other players' capacity coming on stream, and do you see any effect going forward on the market in terms of higher competition or pricing? That's the first. The second is on the pricing in the digital solution, how is going on this side? And I was wondering if you are still supplying part of the USA demand from the European plants. The third question is maybe on the data center, which are growing above the rest within the industrial and construction. Can you just share with us some number? What is the growth that do you see coming in terms of revenues by year end? And the very, very final, sorry, is for Francesco. The Forex impact the impact at the adjusted EBITDA level is very clear. If I can share with us the potential impact, if any, at the free cash flow level. Thank you.
Thank you, Monica. So power grid demand in US is certainly more balanced with supply than it was 1 year ago. Some competitors, likewise us, are completing their expansion capacity. But demand is still growing, because there is a lot to do in power grid, and the one big beautiful bill is pushing utilities to invest more in strengthening the grid, in making also the expansion data center feasible, achievable. Because as far as today is concerned, this data center expansion is somehow constrained by the lack of electricity delivered to the new location. Price evolution is early to say, but said before, also in this space, we will benefit from tariff or copper tariff applied to cable imports, and not only to raw material. Digital solution demand is super strong. We are still using European capacity, which was a great opportunity for us to gain market share, because activating this flow using existing capacity in Europe, we could respond to the market surge in demand faster than the local players like Comscope and Corning. It is true that we will probably see, and as of today, we will see 15% import tariff applied to this flow. But the benefit of the share gain will outpace the possible margin contraction resulting from this 15% tariff application. Data center demand is so strong that is overshadowing the softening the rest of the non-residential business. In terms of growth, we will perform in 25 twice as much revenues than what we had in 24. And this is not just due to the expansion of data center per se. It's also due to the fact that we are a full-fledged player in data center. We sell the full range of cables, from digital solution to electrification to power grid, and somehow also in transmission. So this is a unique position, secure thanks to our synergistic portfolio. And data center use case is the best use case that proves how crucial for us is to have this synergistic portfolio, and so such a broad portfolio. Francesco?
Thank you, Thank you, Massimo.
Thank you, Monica.
The Forex impact. Hi, Monica. Thanks for the question. The Forex impact at the free cash flow level depends on of course, on the conversion rate of EBITDA into free cash flow. So to simplify, let's say that if versus the original guidance, the Forex impact on EBITDA is around 80 million, you can assess in between 40-45 million in terms of impact on the free cash flow. Of course, also in this case, it is taken into account already in the new guidance upgrade of free cash flow that we have given.
Okay, perfect. Very clear. Thank you very much to all of you.
You're welcome, Monica.
Thank you. We will now take the next question from the line of Xing Wang from Barclays. Please go ahead.
Hi, thank you for taking my questions. So maybe I'll ask one on digital solutions. On channel, obviously, it's already contributing to strong top line and margin. Can you replicate their model to legacy Prysmian digital solutions business so we get further upside?
Thank you, Xing. We already have this model of combining connectivity with cables outside the US. In Europe, we have a stronger connectivity business which supports the cable business. In APAC also we have the same solution. So channel was the best opportunity to complement our cable business in US with connectivity in what we consider the US the largest by far and fast growing fiber to the home market in the world. So there's no need to replicate it because you already have it, but this will boost the opportunity in US.
Okay, that's really good to hear. Does that mean that we can expect 30% EBITDA margin for the segment anytime soon?
you have to take a proper balance between margin at channel are about 35%, margin at Prysmian are in the legacy Prysmian perimeter around 12, 13, 14. 30% will not be the proper weighted average of the two margins, but they will certainly go above 20% mark. That's coming from 12% is a significant accretion of the global margin of the group.
Okay, good to know. Thanks. And then the other one is a technical one. So I want to confirm on the hybrid borrowing, this 1 billion, the borrowing cost will go out as dividend instead of financial expenses. So there's no change to how we think about financial charges this year. Is that right?
It is absolutely correct. They will be out and treated as dividend, so they will not impact interest expenses in the profit and loss. They will not impact free cash flow also, because basically they will impact the debt, because the coupon will be distributed and treated as a dividend, so it will impact debt but not free cash flow. The only nuance is that the hybrid interest will impact, on the other hand, EPS, are impacting EPS. And by the way, in the estimate that I'm giving, of course, I considered this because being treated as preferred dividend, the net earnings are adjusted to account also of hybrid bond interest expenses, but only for EPS calculation, not for net income.
Okay, that's very clear. Thank you very much.
Welcome.
Maybe the last one, if you can comment on this. So you mentioned, so when people ask about the backlog or tendering activities in transmission, you said obviously H1 market activity was not so satisfying, but H2 we can expect some level of activities from National Grid and IPTO or IPTO. Obviously, we all know there's one problematic project right now that one of your peers is having. And yesterday they commented on the call that the other possible plan B is to work with IPTO on another project. Do you think that compromise your competitiveness in future tenders with IPTO? How do you view yourself positioned for IPTO tenders versus other market participants?
No, it's for us kind of not easy to comment about competitors' projects, but our position at IPTO is pretty strong, and we don't see any impact coming from other competitors in our relationship and leadership with the IPTO business.
That's very clear. Thank you very much.
You're welcome.
Thank you. We will now take the next question from the line of Miguel Borrega from BNP Paribas Exane. Please go ahead.
Hi, good morning, everyone. Thanks for taking my questions. I've got a few first on low voltage. I remember last time we spoke, you returned to making a 15% EBITDA margin in the US. Does that apply to only Encore Wire or also Prysmian US? And then just a measure of comparison, can you share how much you're making in Europe at the moment? I would imagine a little bit lower than the US. And maybe big picture, how is the competitive landscape in Europe? Does that come from also foreign players, or is the market more fragmented on a local level? In other words, why doesn't Europe do the same as in the US?
So the EBITDA margin US is 15%, including Anchor and including the legacy Prysmian. So in Q2, we restored thanks to the solid market demand and our pricing leadership, 50% EBITDA margin across the entire INC space in US. Europe is around, it depends on the different countries. There are countries at 7%, there are countries at 15%, similar as US. I'd rather also talk about LATAM. LATAM is a country where we are close to the level of margin that we have in US. So there are countries in LATAM where we had 13, 14% EBITDA margin. in average we're 12% in LATAM. So we will of course try to maximize the margin across the board, but you're right, the competitive landscape scenario in Europe is different than that US. And it will never be close to that US because there is fragmentation and because the market is not protected. But still, the differentiation coming from sustainable solution, innovation, so on, will help us outpace the others in terms of margin increase in the INC space in Europe and other regions outside of the US.
Thank you. And so if you're making 10% in electrification and the US makes 15%, what is dragging the margin then?
First of all, you should not confuse electrification and INC. INC we make in US 15%, and globally, as you see, this has been confirmed. But I told you that there are different geographies where the margin is not as high as 15%.
Clear, thank you. And then in high voltage, if I may follow up here, you mentioned limited order intake year to date. How do you explain that? Is that just timing? Are there projects being cancelled or not new tenders going on? And how do you see the supply-demand balance evolving from here? Are you still keen to keep expanding until 28?
It is a matter of size of project and length and complexity of tenders. And you should never read the market as a flat market in terms of order intake per month, evenly spread across the year. So it happens in other years that you had a lot of intake in year one, in first half, and lower intake in second half, and the other way around. This year, there will be a significant level of work in second half for this year as opposed to first half, because this is the phasing of the tenders organized by customers. We haven't seen any project cancellation whatsoever. There is still a significant imbalance between capacity and demand. And as you see, the foreign players are not winning shares in this market because there is a significant technological barrier. And being as the technological leader of the market, we like enjoying creating even further barrier for importers like Chinese or Indians or other companies. The lack of installation capability is the main reason why this European business has not been awarded to Asiatic players. And among these installation capabilities, we are the most capable, thanks to 8 vessels and our continuous effort in innovating in the space of barrier depth, sea depth, installation capabilities. I hope I answered the question, Miguel.
Thank you very much. Yes, you did. Just wanted to confirm also, you're still keen to expanding until 28.
But all projects have been launched in 22, we will continue. And in fact, we have accelerated adding additional expansion of capacity in submarine and land space to cope with the demand that continues to remain strong. I agree.
Thank you very much.
Thank you.
Thank you. We will now take the next question from the line of Alessandro Tortora from Mediobanca. Please go ahead.
Yes, hi. Good morning to everybody. I have three questions, let's say. The first one is a follow-up on the digital solution profitability. Can you give us an idea of the driver behind the margin expansion we saw even sequential, Q1, Q2 versus Q1? I remember that profitability was around 10%, and now we're talking about 14-15%. Because considering the organic growth, it seems much more related, I don't know, to say it's mixed or maybe some savings or pricing. So just understand the driver behind this 14-15, because if understood well, with such a profitability and also probably with a good demand outlook, you mentioned a combined profitability for digital solution closer to to 20%, including channel? That's the first question. Thanks.
So there is an expansion of margins at Prysmian level, thanks to the organic growth in Q2 over Q1. So sequentially, it was pretty high, was almost 10% growth in Q2. And this is also matching what I said before. We are supporting US demand with the European production, making the organic growth stronger than that of other players, local players. And the second component to this EBITDA margin improvement comes from the channel acquisition. So we are blending in Q2 1 month of channel at 35% EBITDA margin with the typical 12, 13, 14% margin of the legacy Prysmian. So this has enhanced the margin of the Q2. And since from now onwards, the channel will be fully embedded in our monthly numbers, you will see the EBITDA margin that was set at 16.8 in Q2 turning towards the 20% EBITDA margin in the coming quarters.
Okay, thanks. And then the second question is, you have a comment on the data center related sales, including channel, and also the comment on twice the revenues we got last year. So basically, considering, let's say, the whole perimeter, we are talking about, I don't know how much, around 10% of your group sales, even though, let's say, group sales are inflated by copper, but let's say around 10% of your group sales could be linked, let's say, to all these data center expansion. That's a, let's say,
yes,
kind of proxy. We can use it.
This is a bit too much. It was last year around 600 million euros, so the revenues associated with the center. This year, with this pace, we will be getting past the 1 billion level. But you should see this in combination with the non-residential space, where while last year there was a strong growth, especially in Q1 and Q2, in terms of infrastructural investment for non-residential buildings, so airport, commercial center, and so on. This year, due to the inflation, the tariffs, the aluminum and copper tariffs, there's been a softening in demand in non-residential. Only when you couple the traditional non-residential with data center, the global non-residential data center market shows an increase. So data center is adding significant growth. Part of this growth is eroded by the softening in demand in the typical and the original no data center space, no residential space. But overall, I said before, the non-residential, including data center, is growing by a mid-single-digit growth.
Okay, and is it fair to say that, let's say, all of these data center growth drivers for you, can we say that is chiefly related to the US market, in the sense that Europe, as you mentioned before, is kind of stabilizing, the INC demand also in Europe, but it is fair to say that so far this data center that driver for you is chiefly a European driver. Sorry, an American driver.
Data center is certainly a strong driver for our growth in US. We are much better positioned in US than in other geographies, but we are working on it. We have a significant share in US and a limited share in the other European country or APAC. But we are especially running one-off projects, one-off activity to create more engagement with the contractors in Europe, which are the real channel to market to data center expansion, conversely from distributors who are the channel to market in US. So we are adjusting our go-to-market channels in order to be also in Europe a significant player in the data center space.
Okay, thanks. And sorry, the last question is just on the EPS growth, let's say, target for the current year, above the 20%. If you can help me to understand the capital gain, the amount of the capital gain, also including the last disposal you made from YFC that clearly would help this bottom line, and the expectation for financial charges for the full year. Thanks.
Yeah, I start from the second, Alessandro. The expectation of the financial charges for the full year is in between 270 and 275 million.
Okay.
So as I was commenting, a second half, which is slightly declining, slightly decreasing compared to the first half.
Mm-hmm.
On YOFC, we sold so far a 8% stake, actually not so far, year to date June, 8% stake, moving from 23.5, 23.3 down to 15%. Then we sold on top another 5% in July. On the part realized by June, the gains were around 30 million, say 29 million to be exact. And on the I'm checking on the second on the part which was already done in July, the gains are let me say 45 million more or less. Not, of course, not included in our half results yet.
So in the remaining 5%, the capital gain was 45.
Correct. Because it was sold at a much higher price.
Okay. So let's say we can assume so far with your disposed stake, this 29 million plus 45.
Correct.
Okay, grazie.
Prego.
Thank you. We will now take the next question from the line of Vivek Midha from Citi. Please go ahead.
Good morning, everyone, and thank you very much for taking my questions. I have two, if I may. The first is on the transmission pipeline. One of the US high voltage companies commented on their call that they've seen a softening in the European HVDC project pipeline due to affordability concerns for customers. What are you seeing here? How are you seeing the European pipeline develop? Thank you.
We haven't seen yet this possible softening, but it is true that after a big wave of awards that happened 22-24, TSOs will have to realize that capacity is not yet at the level they need to have a shorter distance between the award and the start to execute the start of the execution of the project. So I think now the demand is adjusting down, adjusted down. It's adjusting to the level of capacity and taking stock of the fact that the capacity is fully saturated across all players until 28, 29. And so we confirmed the 15 billion level of market in the coming years, as we said a few months ago.
That's very helpful. Thank you. And my final one is just a follow-up. Really appreciate all the color on the copper tariffs, the impact on copper imports. I'm a bit curious around the copper rod imports. You mentioned that's about 25% of the market. I'm just curious, how much spare capacity do you see within the industry for the existing US rod mills, i.e. if there's any reduction in those imports of copper rod, can all that shortfall be met by the US mills that are existing, or indeed any new addition to the market, or do you see any risk of shortages? Thank you.
US players, rod producers are investing to expand local capacity. Only 25%, as you said, is the gap between the demand and the current capacity. We are also planning to invest in new rod capacity in anchor wire. It's part of the plan for synergies. So gradually, this 25% gap is meant to fade away over time.
Understood. Thank you.
You're welcome.
Thank you. We will now take the next question from the line of Lucas Ferrani from Jefferies. Please go ahead.
Thank you. I'll have a few as well. Maybe we do them one at a time. Just the first one is also on copper and also the discussion in the paper on copper scrap. Do you see that also as a win? Because that can be used, that generally comes at good prices, and now they're forced to keep it domestic. So can you talk again about kind of copper recycling and your use of copper scraps, and whether that could be also a competitive advantage on price? Thank you.
The copper scrap is sold to the market at a discount over COMEX. So when the COMEX went up from $10,000 to $15,000, there was still a discount over the level of COMEX. So the real benefit is that we have, regardless of the level of COMEX, some, let's call it, should not disclose it, but anyway, it's $300 saving per tons of copper produced at anchor wire using the scrap. Of course, as we edge towards higher recycled copper in our rod facility at McKinney, this $300 per ton saving is going to increase. We used to have an average of 15% recycled waste in our copper rod. Now, thanks to the excess of waste available in the US market, this level has risen to 30%. So this level of saving, the level of saving is growing. Yeah, that was probably, is that clear, Lucas?
Yeah, no, that's clear. Then the second one was just on the hollow core fiber technology. Can you talk a little bit about the agreement? Essentially, you're kind of buying the IP and then you can sell the cable. Will that work as a JV? Can you take us a little bit into how that will work financially and also generally on the size of the market there? My understanding is that it's only really required in, peak application, and the total addressable market is probably quite small. So just wanted to have your view on those 2 points. Thank you.
Aside from the market, this is a new market. For the time being, this technology was not available. This company, RelativeNet, developed a solution, and they are the commercial partner to us. They have sold cables to Microsoft, other players, hyperscalers, which they were not able to produce apart from what they could do in their lab. So we became the industrial partner to this company. So we are industrializing their solution, their process for hollow fiber in our factories in Europe. So the combination of these two companies, us and the RelativeNet, will provide the market with an industrial cost-competitive solution to sell hollow fiber to hyperscalers, enabling them to distance the data center further out. Then what will be the market size? It is early to say. We have to wait to see what will be the cost for this industrialized solution. Certainly, there's a lot of interest from data center because the current latency of the fiber solution sets significant constraints in terms of selecting the possible areas where data center could be built. So we will have to figure out this market size in the coming years, but certainly the profitability of this solution is pretty high as we speak. Pretty high.
Thank you. That's very helpful. And then the last one was just on what you're doing exactly in the specialty business in the automotive segment. I think if I understood correctly, you said you were kind of in the last process of divesting some of the automotive exposure. Do you mean kind of winding it down where you're no longer producing some of those kind of more commoditized automotive cables, or are you actually selling some of the factory capacity? Thank you.
We are selling the asset, the equipment, and the customer attached to, or the contract attached to this business for 3 plants out of the 7 plants that we had in our perimeter. And these 3 plants disposal, one has happened already in Q1. The other 2 will be completed in Q3.
And what would be roughly your exposure to automotive after that in terms of revenues or EBITDA?
We had before some 600, 700 million revenue, worth of revenue in this space. With this disposal, we will reduce this 700 down to 450 million, only on business that is worth keeping, like the one that we have in the US.
Okay, perfect. Thanks a lot.
Thank you very much.
Thank you. We will now take the next question from the line of Chris Leonard from UBS. Please go ahead.
Yeah, hi there. Just 2 quick ones from me, if I may, please. The first is regarding the US dual listing. I just wonder if you can give us a timeline about when you might consider repositioning on that, given acquisitions now have been bedded in with Encore Wire in the business for more than a year and channels going well. Equally, the US market looks like it's going to be very strong on the back of commentary on the copper tariff. So I just wondered where your thinking is there on dual listing. Thanks.
Thank you, Chris. For us, this is still a project on hold. We are super focused on the execution of what we have to complete. The transmission growth is solid, but we are still a few steps to target the 1 billion goal for 28. We are just entering to the channel integration as we speak. And by the way, the or not will continue through year end. And so the real integration will be more executed in 25, 26 and 25. So we also invested much more time in engaging US investors than we did in the past. So try to capture in a way the benefit of US dual listing without performing US dual list. It remains an opportunity. At the proper time, we will make the relevant decision.
Okay, super clear. Thank you. And the second question was just on the guidance range and thinking of the upper end. Is there anything you can help us on the sort of moving parts of what might take you to the upper end of that guidance range at EBITDA? Thanks.
As said before, 24 hours ago, we didn't think to modify it and to consider the upper end really within reach. Now let us assess what the new dynamics of the market in the US will be following the announcement of last night, and we will be more specific in the coming months. But as said before, we feel much stronger than 24 hours ago as far as delivering the guidance and some upside.
Sure. And as a follow-up to that, was there much in the upper end of the current guidance range that was attributed to sort of I&C and the electrification business, or were you more focused on power grid and transmission?
I think I&C, electrification, power grid would be the possible upside over this current guidance, having transmission be fully recognized in this guidance already, and digital solution as well, apart from the channel piece that we had 1 month actual. The trajectory and the trends and the outlook for the coming quarters is positive, but we have to wait and see what happens. So there are 3 possible areas of upside: channel, power grid, and electrification.
That's really kind. Thank you for the color. Have a good morning all. Thanks.
Thank you. Welcome, Chris.
Thank you. There are no further questions at this time. I would like to hand the conference back to Massimo Battaini for closing remarks.
I'd like to thank you for spending this time with us. It's been very useful to hear your question and try to answer your question with giving you the sense of what's happening in the market. There's a lot of things that happen at once, but I see very positive about quarter 3 and quarter 4. Looking forward to talk to you in the coming quarter. And for those of you who are going to have a summer break, please enjoy the break. Thank you very much.
This concludes today's conference call. Thank you for participating. You may now disconnect.